What is up, you guys, and welcome back to my channel. Today I'm gonna tell you about one of my secret indicators that I use to pick stocks with, which has resulted in returns like this so far this year, and this from when I started this portfolio. And to fully understand this investment method and if it's for you, you're gonna want to see the whole video, so keep watching. You've probably heard that you should buy low and sell high. It goes without saying that this is a pretty good strategy. But what would you say if I told you to buy high and sell higher? This means buy the winners. This is what is called the momentum strategy. Studies have actually shown that the winners continue to be winners and the losers continue to be losers on the short and medium term. And if the market was completely efficient, this effect wouldn't exist. But now it does, so we might as well use it and get better returns. The momentum strategy of buying high and selling higher is thus a bit opposite to the fundamental analysis, where you want to buy undervalued stocks and wait for everyone else to grasp the potential and start to increase the value. Instead, the momentum strategy is to take advantage of the trend of an already popular stock. I myself used momentum as an indicator in a couple of my strategies in combination with other specific key figures. But it's also possible to use momentum on its own without combining with any other factors. Why does this strategy work? It's not entirely clear actually why the momentum strategy actually works. There is a certain inertia in the market. There are many studies that indicate that in the long run, previous loser stocks beat previous winners over a period of 3 to 5 years. But if we look over shorter time periods, this is different. And over 3 to 12 months, it actually looks like the old winners actually continue to do better than the losers. And this is what is called momentum. There are many studies on the momentum strategy during different time periods and on different stock markets in different countries. But I just want to show you one example here. Here, the stocks on the New York Stock Exchange have been divided into 10 different groups according to the price development they had in the past 6 months. So those in the group 1 had a worse development and those in group 10 had a best. Then the study followed these stocks to see how they developed after another 6 months, 1 year, 2 years and 3 years. And as you can see, the stocks in the best group did much better after 6 months and 1 year, while after 2 and 3 years there didn't seem to be so much of a difference anymore between the groups. But after 6 months up to 1 year, the stocks that performed the best in the previous period produced higher returns. The price of a stock is mainly driven by reactions to positive and negative news from companies. And every time there's a positive news, the price tends to take a fairly quick jump up. But often the reaction doesn't end there. But there's some kind of lag that continues to increase the price after this event. Either the reaction was too small, there was an initial underreaction to the new information, or there's an overreaction afterwards, which later makes the price drop down somewhat. It may also be that institutional investors react faster and us small potatoes doesn't react as quickly, and therefore there's this slight lagging reaction. But because it seems that retail traders, at least to some certain extent, drives this effect. The momentum strategy is thus more about human behavior than about the underlying economic or fundamental factors. Psychologically, we want to bet on the winners and believe that the stock that has risen a lot will continue to do so. And thus more people jump on the trend and the stock goes up even further. And even more than it should perhaps, if we just factored in the fundamental economical underlying factors. And this is what we try to take advantage of with the momentum strategy. As an example, think about what often happens when the stock market has been going up for a long time. More and more people see that some have already made money in the upturn, and it encourages more people to buy in. And the same applies to an individual stock. And the same thing also applies when the stock market falls, of course. A stock market crash is usually not rational, but it's driven by human behavior. Someone starts selling, then the stock market turns down, and more people panic and sell. As I use this method, it's in the medium term, over a quarter up to a year. I like this strategy a lot because it removes all feelings for the stocks. It doesn't matter how the company does financially, it doesn't matter what the company does, how the company earns its money, or what industry it operates in. And you don't have to do a lot of time-consuming analysis either. But the only thing you have to look at is how the price have developed during the previous period. It kind of disconnects all the emotions that might otherwise come into play about what you think about the company or its way of making money. So to the most important thing, how do you actually use the momentum investment strategy in practice? There are a few different ways of doing this. Some tend to look at 6 months development only, some take the average of 3, 6 and 12 months development, some only look at the 12 month development, and some even subtract the development of the last month. It's difficult to say which one of this is the absolute best way to do it because it depends on which time period you look at and which stock market. So just choose one of these if you want to try this method for yourself. Then it all comes down to simply ranking all the stocks that you're interested in. It can be, for example, that you only want to own US stocks, you only want to own stocks from large cap companies, or you only want a certain trading volume and so on. So say that you want to invest in large cap and you want to look at the price development during the previous 6 months. Then you simply make a list of all the large cap stocks and their price development in percentage over the past 6 months, and then you sort the list to find the best stock to invest in according to momentum strategy. So it's very simple to use this strategy actually. Then you just hold on to this stock for a certain time period, typically about 3 months up to a year, and then you redo the analysis again. You sell those stocks that are not on the new list and you keep those that are, and then repeat. If you're going to invest according to the momentum strategy, you can pick around 10 to 30 stocks for a portfolio. It depends a bit on how many stocks you own otherwise. If these are the only ones, preferably pick over 20 to reduce the risks. If you already have a lot of other stocks, you usually get a higher return if you have a more concentrated portfolio. So then 10, for example, may be enough. But the fewer you have, the more volatility you can expect as well. Then there are those who use the method together with some other factor that they want to invest according to. For example, there are several studies who suggest that you should combine value stocks with momentum. It has been seen that you can get higher returns by combining these two factors than by just using momentum or just using value on its own as an indicator, for example. If you want to combine momentum with another factor, you can simply list all the stocks again that you're interested in and sort them first based on the other factor that you're interested in. If you want to invest in value, for example, let's take a simple example and say that you want to buy stocks with a high book to market value. These are what we call value stocks. So if you sort the stocks first based on the book to market value, and then you select the top results from this sort. Say that you select maybe 10 to 20% according to this indicator, depending on how many you had from the beginning. And then secondly, you sort these 20% according to the momentum. Then you pick the top maybe 10, 20, 30 stocks from this list. Then you can of course also combine momentum with other factors. You may be interested in dividend stocks, for example. Then you could pick the top dividend stocks according to some criteria. And then you sort them in the next step according to momentum. Or maybe you're only interested in smaller cap stocks. Well, then you can sort the smaller companies according to momentum, and so on. If you don't want to pick stocks yourself, there are also some funds and ETFs that invest according to the momentum strategy, or that are managed according to this strategy. But do look into this strategy more exactly if you are interested in them, because there might be some differences between the funds and how they're managed. As I use this method, I first sort on other indicators that I'm interested in, then I pick the top part of this and sort this further on the average of 3, 6 and 12 months of price development. And then I do something that maybe is a little bit surprising if you know me, because I actually go in subjectively and look into the graphs, because I would rather invest in a stock that looks like this than one that looks like this, although they may have the same average of the price development. I've only done this purely intuitively, or what you might call it, but when I did some research for this video, I actually found some sources that claim that this might actually be a good way to go about this. That you would rather want to invest in a stock with a price development that is a bit slower, rather than where it seems to have gone up very quickly on some news maybe, and then it's more flat further on. Even if these two have the same momentum. If you didn't look in the graph, you wouldn't see this difference. They would seem exactly equally as good according to the momentum strategy. There's probably certainly some figure that I should be able to replace this slightly more subjective graph looking with, so I should probably be able to come up with something that makes this a little bit more objective in the future. Yeah. I definitely should. Now, I'm not saying that you should use this method or copy me in any way. I just want to show methods that have worked previously to achieve excess returns compared to the market or the index. But To get a certain excess return, it takes a lot of discipline if you really want to do this. And there are no guarantees that this will actually work in the future. So I really don't want you to copy me and then come back and be mad at me because it didn't work for you. But choose an investment style that resonates with you, that you like the best, and that you think that you can stick with long term, and understand the method, why it should work. I think this will get you far, or further than you would by just copying someone else's strategy without really understanding them. And I still have only a small part of my money invested according to these strategies. Most of it is still in index funds. Even though in hindsight, I wish I would have invested everything according to this strategy. But how good is the momentum investment strategy really? Various research studies show returns of 15% or more per year. It depends of course on which time periods you look at and which country's stock market as well. But you can compare it with the long-term return of 8 to 10% that the stock market in general returns per year. It may not seem like a huge difference to have 15%, but while it would take you about 23 years with a 10% return to reach 1 million if you invested 1,000 per month, it would only take you 18 years with a 15% return. And after 23 years with 15% return, you would have more than twice as much as if you have received a return of 10%. Compound interest in action, guys. So it would be a pretty big difference in the long run. So what should you look out for if you want to use the momentum investment strategy? There are especially risks with the momentum strategy when the market turns very suddenly. Take the dot-com bubble as an example. The stocks that performed best according to the momentum strategy before the bubble popped, it was the IT stocks. And these were also the ones that crashed very hard. So it's something that you should be prepared of. If you still want to use the momentum strategy, also be aware of companies whose price has been driven up a lot by pure speculation. It usually doesn't last that long. What you want to find with this method is good companies that have performed well out of fundamental reasons as well. And this is why the price is going up, not bad companies that are increasing in price for some other reason that doesn't correspond to the company's real situation. Also avoid stocks with too little free float. That is, the companies that are not traded that much on the public stock exchange. Then individual trades can drive the price just because there are so few shares publicly available, and it can give false momentum figures. It will also be difficult to get out of such stocks if you want to sell, if there are not that many people interested in buying them. The momentum strategy also applies on the opposite situation, of course. So the stocks that have performed the worst during the last 3 to 12 months tend to also perform the worst over the next 12-month period. So it could be something to watch out for in the future as well, and simply avoid buying these stocks. It's of course also possible to combine this, where you can go short in these stocks that have the largest negative momentum, to also take advantage of this. But if the momentum strategy is this good, why doesn't everyone invest like this? Good question, I'm glad you asked. This is due to something that is inherent in all strategies that promise better returns than the index. To be able to beat the index, you must differ from the index. So you cannot beat the index simply by investing in exactly the same stocks and in the same proportion as the index. So first and foremost, to be able to beat the index, you must have stocks in other proportions than what would be included there, and not all of the same stocks, of course, that are included either. And what will happen then is that for such strategies that promise to be able to beat the index in the long run, there will be months or even years where the strategy will outperform the index, but there will also be periods where the strategy will underperform the index. And it's precisely in these periods that it's so difficult to stick to these methods, when the portfolio underperforms. And this can be everything from a few months to even several years. It's not possible to foresee either how long this underperformance period will last, and it's difficult or impossible probably to predict when these periods of underperformance will occur. So the risk is that you start following a certain strategy until it starts to perform badly. Then you move on to the next strategy instead, and so on. And it will most likely not lead to better returns or outperforming the index. So in order to really take advantage of the returns with a strategy like this, it's important that you're prepared to keep it long term. Then there's still no guarantees that this method will work in the future just because it had worked historically. As the stock market and everything else changes all the time, the economic landscape changes constantly. And just think about how much much easier it has become to get access to all the information around stocks and companies and their financials and all other interesting metrics since the internet came. Just this alone changed a lot. Who knows what will happen in the future? So what I think is important to be able to stick to an investment method is to understand why the method works and understand these aspects of it, that it will have positive years but it will also have negative years, and that you're still prepared to persevere, which I think is difficult for many people. I think it's especially difficult if you jump on a strategy at some point and then it starts off by underperforming, because then you have no history to fall back on. Then it's easier to think instead, oh, how much money I would have made if I only invested in the index instead, or if I only used this method instead. That's why I think index funds are the best for most people. But that's not why you're here, of course, is it? What you can do is not only invest according to the momentum strategy, for example, but also combine this with other strategies that don't behave in the same way. It can be easier than if not all of your invested capital underperforms for several years, but only a part of your portfolio does, while others perform better. Guys, hit subscribe, and I'm going to tell you everything I know about the stock market and a little bit more. Don't forget to hit like, keep watching this video that appears on the screen now, that will show you more about how money and the stock market really works, and I'll see you again next time.